Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today we are taking a deep dive into this absolutely massive divide between American and European consumers right now.
Yeah, it is a staggering contrast when you actually look at the numbers.
It really is. I mean, looking at the recent analysis from June 2026, the U.S. personal savings rate has just plummeted to like a tiny 2.7%.
Right, which is incredibly low.
Exactly. But then you look across the Atlantic, and in the Eurozone, their savings rate is sitting at this massive 14.3%.
It's a huge gap.
To put that into everyday terms for you listening, imagine two friends getting paid on a Friday. The American friend gets that direct deposit, immediately heads to the mall, buys a new flat screen TV, and, maybe books a flight for a weekend trip.
Yeah, living it up.
Right. But the European friend gets the exact same paycheck, goes straight home, and quietly stuffs the cash under the mattress.
It's one of the most glaring, kind of counterintuitive economic puzzles out there today.
Yeah.
Because we aren't just looking at a quirky cultural difference in how people budget for groceries, right?
Right. Way, way bigger than that.
Exactly. That 14.3% in Europe is a structural anchor dragging down their domestic economy.
Yeah.
But at the same time, it's creating this massive coiled spring of capital.
Which brings us to our mission for this deep dive. We're going to figure out exactly why this divide exists, how it works, and most importantly for you, how this giant sea of idle cash in Europe might actually be like the biggest hidden opportunity for your investment portfolio.
Yeah, there's a lot of upside if you know where to look.
So let's start with the immediate assumption. I mean, when anyone hears that an entire continent is saving 14.3% of their income and just refusing to spend at the stores, the natural thought is, well, they must be broke.
Right, people just assume they have no money.
Yeah, that the economy is in shambles, unemployment is skyrocketing, and they simply don't have the cash to buy a new TV.
But that is actually a total myth. If you look at recent analysis from the European Commission, it completely shatters that assumption.
Really?
Yeah. Based on the macroeconomic data for the first quarter of 2026, real household income in the Eurozone actually grew by 0.7%.
Wait, grew? Like, are we factoring in inflation there?
We are. That is real income. So their actual purchasing power went up. The everyday European consumer is objectively making more money.
Oh, wow.
Yeah, their wages are catching up to the inflation spikes the past few years, and unemployment is actually historically stable.
So, wait, they literally have the money sitting right there in their checking accounts, but they are just actively choosing to ignore it.
They are, because while real income grew by 0.7%, the data shows real consumption actually fell by 0.2% across the European Union.
That is wild. I mean, if my paycheck goes up and outpaces inflation, my instinct is to, go out to a nice dinner to celebrate.
Sure, that's the standard American reaction.
If they have the means, what is stopping them from spending?
Well, it comes down to this behavioral economic concept known as precautionary saving.
Precautionary saving. Okay.
Yeah. Basically, it's driven by deep psychological scarring. The European consumer is currently operating under severe crisis memory.
Crisis memory. Like they're just waiting for the other shoe to drop.
Exactly. Think about the geographic and structural reality of Europe compared to the United States. They've faced a relentless, compounding series of shocks over the last few years.
Right.
First the pandemic, then the invasion of Ukraine right on their eastern border, which instantly triggered massive energy price spikes.
Because Europe relies so heavily on imported natural gas.
Right, precisely. And now, looking at the geopolitical landscape in 2026, we have a war in the Middle East driving global energy prices up yet again.
Which hits them much harder and faster than it hits us here in the U.S.
Oh, absolutely. The United States is largely energy independent. When global energy markets panic, Americans might see a little bump at the gas pump.
Yeah, maybe 50 cents a gallon or something.
Right. But for a European, they are instantly terrified about whether they will literally be able to afford to heat their home this winter.
Wow, so it's a much more visceral fear. I always think of it like getting caught in a rainstorm without an umbrella. If you get soaked once, it's just bad luck. But if you get soaked 3 times in a row, you start carrying an umbrella every single day, even when it's sunny out.
That is a perfect analogy. The IMF recently lowered its growth projections for the Eurozone, specifically pointing to these exact energy market shocks. Europeans aren't saving to buy a boat, they are saving out of rational fear.
They're holding on to cash because they are terrified of the next utility bill.
Exactly.
And, that physical cash hoarding is actually literal. There's this data point in the Eurostat research that I found absolutely mind-blowing.
Oh, the banknote circulation.
Yes, I mean, we live in a world of digital wallets, tap to pay, Venmo, all that. But despite digital payments rising globally, the circulation of physical euro banknotes has completely surged.
It really has.
According to the data, it went from about 1 trillion euros in 2016 to 1.6 trillion euros in 2026.
That is an astonishing volume of paper money being literally pulled out of the digital system and kept in physical form.
Right. People in countries like Germany and Austria are literally being advised by local authorities to keep emergency physical cash at home for disasters.
Yeah, they are told to prepare for extreme weather, cyber attacks on the banking grid, or regional conflicts.
So for them, cash isn't just a way to buy coffee anymore. It has functionally become a disaster insurance policy.
It really has. European physical cash hoarding is quite literally a trauma response.
Yeah.
But this is where we have to look back across the ocean at ourselves.
Right, the American side of the equation.
Because Americans are reading those exact same scary geopolitical headlines. We see the news of the Middle East, we see global supply chain issues, we have our own crazy climate events.
Yeah, totally.
So why is the American trauma response to drop our savings rate to 2.7%
Yeah.
and just keep swiping our credit cards?
That is the big question. Especially right now, under President Trump, there is this massive spotlight on the resilience of the American consumer and the sheer momentum of our domestic economy.
Right.
But it does make you wonder, what is fundamentally different about the American financial mindset that makes us so comfortable living on a 2.7% margin of error?
Well, it is driven by a very specific, very powerful economic engine called the wealth effect.
The wealth effect. Break that down for us.
The wealth effect dictates that when people feel richer on paper, they spend more money in reality, even if their actual liquid cash flow hasn't changed at all.
Oh, okay.
And this is fundamentally tied to how household wealth is structured in the United States versus over in Europe. Based on Federal Reserve data, roughly 58% of U.S. households own stocks.
Right, either through direct brokerage accounts or, primarily through our massive 401k and IRA retirement systems. We are just culturally conditioned to have our money in the market.
Exactly. And when the U.S. stock market booms, which it has been doing, largely fueled by this massive wave of investment in AI and tech game, a huge chunk of Americans open their retirement apps, see double-digit percentage gains, and suddenly feel incredibly wealthy.
I see it happen all the time. It is perceived liquidity.
Yep.
It's like checking your Zillow estimate for your house or opening your Vanguard app and seeing your portfolio jumped up by 15 grand this year. You haven't actually sold the house, right?
No, of course not.
You haven't liquidated the mutual fund. The money is not in your checking account. But because that paper number is green, you turn to your spouse and say, you know what? Let's go out for a really fancy steak dinner tonight.
Exactly. You spend as if that money is already in your pocket. That confidence is the foundation of the current U.S. economy. But look at the European structure.
How is it different?
In Europe, direct stock ownership makes up only about 5% of their total financial assets.
Wait, just 5%? That is practically non-existent.
Right.
Where are they putting all their money then?
Cash and bank deposits make up about 32% of their financial assets. The rest is largely tied up in boring insurance products or state-sponsored pension systems where they don't see a daily fluctuating balance on an app.
Ah, I see the disconnect now. So if the STOXX 600, which is essentially the European equivalent of our S&P 500, goes on a massive 20% rally, the average Parisian waiter or German engineer just doesn't feel it at all.
Not at all. There is no fancy steak dinner moment for them because they don't own the underlying assets that are going up in value.
Right.
Their daily confidence isn't tied to a booming tech sector. It is entirely tied to their monthly paycheck versus their monthly utility bill.
And since we already established they are terrified of those energy bills, they just keep hoarding cash.
Exactly.
Okay, let's look at the actual mechanics of what happens when an entire continent decides to just sit on its cash like this. Because if everyone hoards their money, doesn't that just freeze the entire economy?
It does, and economists actually call this the paradox of thrift.
The paradox of thrift.
Yeah, the underlying mechanism here is the velocity of money.
Okay, let's break down the velocity of money for someone who might not remember their Econ 101 class.
Sure. Simply put, the velocity of money is the rate at which one unit of currency is exchanged in an economy.
Right.
So if you take a $20 bill and buy a coffee and a pastry, the cafe owner takes that $20 and pays their supplier. And then the supplier takes it and pays their delivery driver. That single $20 bill just generated $60 of economic activity because it moved quickly.
I love that example. But if I take that same $20 and stuff it under my
The
mattress,
velocity drops to absolute zero. That economic activity just vanishes.
wow.
If one person does it, it's a smart personal budgeting decision. But if an entire continent does it simultaneously, retail sales plummet. If people stop traveling, so airlines suffer.
Right. And then companies see declining revenue, so they stop hiring.
Exactly. Which triggers even more fear, causing people to hoard even more cash. It is a self-fulfilling downward spiral, and it is the exact reason why the IMF projects U.S. economic growth at a robust 2.3% for 2026, while the Eurozone is crawling along at a miserable 0.9%.
Okay, but hold on. I have to push back here.
Sure, go ahead.
If the velocity of money has completely crashed in Europe, retail is dead, and the domestic economy is growing at less than 1%, then European stocks must be incredibly toxic right now.
It seems like they would be.
Right. Why on earth would I, as an everyday American investor, want anything to do with European equities if their own people won't spend a single dime?
That is a totally logical assumption, but it ignores the reality of modern global markets. According to Reuters market data from August 2026, European stocks are actually trading near record highs.
Wait, what?
Furthermore, their corporate earnings growth expectations recently hit a 4-year high.
Okay, that makes absolutely no sense on the surface.
Right.
How can the stock market be at record highs when the local economy is basically flatlining?
Because the stock market is not the local economy. When you buy shares in massive European conglomerates, you aren't betting on the spending habits of the local European consumer.
Oh, I see where you're going with this.
Think about the titans of the European indices. You are looking at global luxury goods conglomerates, massive multinational pharmaceutical companies, aerospace giants, international energy firms.
Of course. A luxury fashion brand headquartered in Milan doesn't really care if a local Italian worker is hoarding cash to pay for winter heating.
Exactly.
They care that the American consumer in New York, who is riding high on the wealth effect, is perfectly happy to drop $5,000 on a new handbag.
Spot on. These companies generate a massive percentage of their revenue far outside of Europe's borders. They are harvesting the wealth effect of the U.S. and the growing demand from Asia and the Middle East. They are completely insulated from the fearful European consumer.
Okay, I get how the multinational exporters survive and thrive. But what about domestic institutions? Like, what about European banks?
Oh, the banks are doing great.
Really? Surely if nobody is taking out loans to start businesses or buy houses because they're too scared, the banking sector must be collapsing.
Quite the opposite, actually. The European banking sector is quietly executing one of the most profitable maneuvers in the market right now, thanks specifically to that 14.3% savings rate.
How does that work?
We have to look at the mechanics of the net interest margin.
Okay, let's walk through that step by step. How does a bank profit when consumers are just depositing cash and doing nothing else?
Well, when a European citizen deposits their euros into a checking or standard savings account, the bank pays them practically nothing in interest.
Right, because the consumer isn't looking for a high yield, they just want safety.
Exactly. So the bank gathers this absolute mountain of deposits for essentially zero cost.
And what do they do with all that zero-cost money?
They park it at the European Central Bank.
Huh.
The ECB has a deposit facility rate, which is the interest rate they pay commercial banks for holding funds with them overnight. Right now, that central bank rate is significantly higher than what the commercial banks are paying their everyday retail customers.
Wow, so the banks are just capturing the spread between the 0% they pay the depositor and the higher yield they get from the central bank.
Exactly. It is virtually risk-free profit, and it's generated purely because the European public is too traumatized to move their money into higher-yielding, riskier assets.
The scale of this cash has to be absolutely staggering.
It is. Based on recent analysis from BlackRock and the European Commission, if you tally up all those idle bank deposits across the continent, there is anywhere from 10 to 14 trillion euros just sitting there.
10 to 14 trillion euros. That is, I mean, the sheer size of that number is kind of hard to wrap your head around.
It's massive.
It feels like looking at this massive V8 car engine just revving in neutral. The fuel, which is all that cash, is burning. The banks are getting hot capturing the friction, but the transmission simply isn't engaged.
I love that.
Because the wheels of the broader economy aren't turning. The capital isn't flowing into innovation or startups or the stock market.
That engine analogy hits the nail perfectly on the head. And European policymakers know the engine is in neutral.
They have to.
They do. They know their core economic disadvantage right now isn't a lack of capital. It's the fact that 14 trillion euros is trapped in checking accounts.
Right.
They realize they can't magically cure the crisis memory and force citizens to go buy new TVs at the mall. So instead, they are trying to engage the transmission.
So how do you force a deeply conservative, risk-averse population to engage their capital?
Through a massive policy initiative currently being pushed in 2026 called the Savings and Investments Union.
The Savings and Investments Union. Okay.
The goal isn't to get them to spend. The goal is to get them to invest. They want to seamlessly transition this idle bank cash into the capital markets.
What are the actual mechanics of that, though? Because you are talking about changing the financial culture of an entire continent.
Oh, it requires monumental structural reform. Europe currently has 27 different sets of national financial regulations.
It sounds like a nightmare.
It is. To make this work, the EU is trying to harmonize bankruptcy laws and streamline cross-border taxes so a German citizen can easily invest in a French green tech startup.
Got it.
But the biggest mechanism they are pushing is auto-enrollment in retirement accounts, basically mirroring our American 401k system.
Oh, wow. So they are trying to create a European 401k.
Exactly. They want to create tax incentives so powerful that the everyday European allows a portion of their paycheck to bypass the bank account entirely and flow directly into European index funds, venture capital, and infrastructure projects.
Okay, so this is the critical moment for you, the everyday American investor listening right now. If the European Union actually manages to drop the clutch on this engine, what does that mean for an American portfolio? Like, why should we care about European pension reforms?
You should care because of the current valuation gap. Right now, even though European multinational stocks are doing well, the broader European equity market is trading at a massive historical discount compared to American stocks.
Basically, they are incredibly cheap. Because there is no domestic demand bidding the prices up.
Precisely. Now imagine what happens if this Savings and Investments Union actually succeeds. If even a fraction, say just 2 or 3 trillion of that 14 trillion euros shifts from sleepy bank accounts into European equity markets, it fundamentally alters the landscape.
Because when millions of Europeans are suddenly auto-buying local index funds every single month, it creates massive, passive structural demand.
Exactly.
It basically creates a permanent price floor. The influx of monthly capital bids up the underlying stocks simply because the money just has to go somewhere.
And they could permanently reevaluate European companies and aggressively close that valuation gap with the U.S. It would transform Europe from a fragmented continent of fearful savers into a unified block of structural investors. For a global investor looking ahead, positioning yourself in European equities before that transmission fully engages could be one of the most lucrative generational opportunities available today.
That is just fascinating. Let's take a breath and recap the journey we've just taken so we keep this super simple.
Yeah, good.
We started with the jarring reality that Americans are saving a tiny 2.7% of their income, while Europeans are hoarding a massive 14.3%. And we discovered this isn't due to a lack of income in Europe, but a deep-seated crisis memory.
Right.
Geopolitical shocks and energy dependencies have just crushed their velocity of money and forced them into extreme precautionary saving.
Meanwhile, the U.S. economy is running incredibly hot, fueled by that wealth effect.
Yeah.
Americans are spending based on the perceived liquidity of their surging stock portfolios and real estate values.
And while this European hoarding creates a paradox of thrift that slows down their local economic growth, it has simultaneously enriched their banks and created this 14 trillion euro stockpile of idle cash. And if this new Savings and Investments Union can funnel that cash into the markets, the resulting structural demand could spark an unprecedented rally in undervalued European assets. It really is a fascinating divergence.
It really is the defining economic narrative of 2026. But before we finish up, I want to leave you, the listener, with a slightly more provocative thought to just kind of turn over in your mind.
Oh, I always appreciate a lingering question. What should we be thinking about?
Well, we have spent this whole time analyzing how consecutive severe shocks like wars, energy crises, inflation trained the European population to stockpile physical cash and abandon the consumer mindset as a pure survival mechanism.
Right.
They adapted to a world that suddenly felt violently unstable. So the question we have to ask is, if extreme climate events continue to escalate, and if global geopolitical instability continues to fracture supply chains, is this crisis-saving behavior truly isolated to Europe?
Oh, that is a very unsettling pivot.
Just think about the fragility of the American model. The U.S. consumer feels invincible right now because the wealth effect tells them they are rich. But paper wealth in the stock market can evaporate in a matter of weeks.
That's very true.
If the United States were to experience a prolonged, localized shock, something that shatters that wealth effect and breaks the illusion of permanent market growth, how quickly could that razor-thin 2.7% savings rate spike to 10%?
Wow.
And if 330 million American consumers suddenly pull back, stop swiping their credit cards, and start saving like traumatized Europeans, what exactly happens to a U.S. economy that relies almost entirely on them spending every single dime they have?
That is a brilliant, slightly terrifying question to ponder as we evaluate the risk in our own portfolios. It really forces you to look at that 2.7% not as a badge of strength, but as a potential massive vulnerability.
Exactly.
Thank you so much for walking us through the mechanics of this incredible divide. It's been incredibly eye-opening. And to you, our listener, thank you for joining us today. Don't forget to subscribe and hit that like button.